Why don't you tell us about your trading strategy?
Okay, all right. This is the Nasdaq, the June Nasdaq that we had to trade. So I'm gonna go to the daily chart. All right, just open this up a little. Okay, so this bar here, I got a couple of lines in there. So if you could just, hopefully you guys can see this bar here is the day of the test, June 8th. Okay, so the market was coming off of this high here on the 27th. So what I do is my methodology works on market balance. They say that the futures markets can exist without balance. The market, like soybeans can't go to the moon because nobody would buy them, and they can't go to zero because then the farmers would have business. So it always has to balance, unlike the stock market where a company could go to zero and be bankrupt. So my method is based on market balance. So what I do is I go in the past 6 weeks. Right now I'm drawing in the highs and lows. So I'm a swing trader, by the way. This is a swing trading method. So this is what I do. I swing trade. So starting at the high, I go back to the highs and lows from the past several swings, and I put these highs and lows into a formula. And the answers that I get, the numbers that I get from the formulas, tells me where the market needs to go in the near future to balance. So the future is based upon the immediate past. So knowing where the market is going to be going in the next few swings, I get that information from going back in the past. So I take highs and lows and I put them in a formula. So coming off of this high here, it's telling me that the uptrend has been completed. So now I'm looking for a swing or two down. Now this is an intermediate high right here. So for every intermediate high, the market needs to make at least 2 swings to the downside. Okay, so here's the first swing down to this low here, and then it pulled up here. So that's one swing down. So there should be at least one more swing after an intermediate high. So coming down here, this is where the market opened. This is the trading day right here, the test day. I'm sorry. The test started here, so it was already down on its. It was already moving down on the second swing. So I knew that I would have to short it. So if I go to the 60-minute chart, all right, I'm having my chart's not showing up. All right, just give me 1 second. Let me go to the. I'm going to go to the next month just because my charts. Sometimes when the contract expires, I lose some of the data. But it's the same exact thing. It's just just the next month. But this is what the June looked like. It had very deep retracement, very deep retracement. All right, on 6/8 where the test started was right here. This was actually Sunday night when it opened up at 6 p.m. That's when I got in. So I look at I know the market balance has to go lower. I know the market has to go lower because of the balance. So I look at the trend strength. I see deep retracement here. Market comes down, deep retracement. It comes down very deep, a ugly double top. Then the market comes down and goes deep, deep, deep. All those deep retracements showing a lot of signs of weakness. So I know that the bottom is coming soon, and that'll be the end of the bottom, the low. So I shorted it here. That's as quickly as I could get in where the market opened on Sunday night. I got in at like 44.83. And now if you notice, I use Fibonacci extensions. Now, all these 261 extensions are all like together. They're cuddling together here. So if I average all these 261s with these deep retracements, I get an average very close to the low. I was within 10 points of picking the low. I sold it here and I bought it down here at 44.05, but the actual low was 43.90 on the June contract. Okay, my charts are back. Okay, good. Sorry about that. So this is the actual June contract. But you see the deep retracements. I sold it here at the opening because I knew the market could only go lower.
And I want to stop you here for a second. So, folks, what he means deeper retracements are basically lower lows. That's essentially what we talk about in the strategy session are those deep retracements, which are lower lows. And what do lower lows indicate? Weakness. So anyway, sorry, Richard, you can go ahead.
Oh, no problem. Yeah, no problem there. Yes, exactly. So deep retracements show a lot of weakness. So then the market comes down. This is where I sold it. And I see a cluster of 261 extensions from these deep retracements. And when I average that in, I got an average of like 44.05 and the low was 43.90. So I bought it. I bought them here after the short, so that was my first trade. And now this low here, 43.90. Now let me go back up to the top. This was the last high, according to my balance prices. So I knew that the market had to make two swings to the downside. So it came down here and it went up, and it came down here. Now I say at least two swings, but then when the market came back up, so I bought it here. That was my first trade was selling it here and buying it here. Then when it went back up, I drew in these two patterns here, and I used Fibonacci extensions. And I didn't sell it at this high here, but I sold it after it started pulling back. The reason is when I recalculate my balance prices, every time I have a new high or a new low, I recalculate the balance. And what it says was the downtrend was going to continue, that there was going to be one more move to the downside. So I knew I could short it one more time. So looking at these two patterns here and their extensions, I see that the market was pretty overextended and it was going to drop again. And also, I used the 78% retracement. I don't know why, but it seems like a lot of times from a high or a low, the market usually retraces a lot of times to its 78% or between 78 and 61. So if I bring it down to here and I put in my 78, and I don't just use the 78, I use the Fibonacci extensions, but I like to put the 78% in, and you see it just retraced a little bit, taking it past the 78%. And you'll see that so many times on a 60-minute chart or a daily chart, the 78%, even on a small time frame. So it pulled back to the 78%. I saw the overextensions here. And I knew that the market had to go down one more time. Now, I shorted it here too at 44.80. It went up to 45.12, but I shorted it around 44.80. And I was taking this down as far as I can, and I really knew that it was going to go pretty far, but the test ended right here. This was the last day of the test right here. So I got out right here. I was hoping that it was going to go down further, expecting to break this low right here. But when it didn't break that low right here, that creates an action swing to the upside as far as swing trading, because you have a higher low. And that action swing to the upside, I probably would have taken it if I traded the NASDAQ, but I never traded the NASDAQ in my life until this test. I trade other markets. So that's what I would do. So going back to the daily chart, now I don't have all my balance price calculations and formulas here, but when this high formed, I knew that was the last high. And coming off of this low here, the balance remained on the short side. So when the market moved up here, I knew that I had to have at least one more swing, because like I said, every intermediate high or intermediate low should have two swings following it. So when this low formed and I recalculated balance prices, what it told me was the valley after the current swing will end the downtrend. So the valley after the current swing. So the current swing at this point is up. This is the current swing. So the valley after the current swing will end the downtrend. So this is the valley after the current swing. Now, at the time it happened, you see that it almost broke this low, and it closed pretty high. It closed up to where it opened. And not until this low is confirmed will I know that this is the last low. And the next day it was confirmed. So from there, then I knew that, well, it didn't matter. The test was over. But as far as the balance prices, the way I calculate them, it's very accurate. So it told me that the valley after the next swing ended a downtrend. It doesn't mean that the next valley has to go lower than the last one, but I knew that from this top it would go down. And then I used Fibonacci extensions to see how far down it would go. And once it was confirmed the next day, then that really was the last valley. And then it goes from there. So just to recap really quick, they say that the future is based upon the immediate past. So I take the several swings from the past to see where the market needs to go in the next few swings in order to find balance. And that's what I base my whole trading on.
All right, Richie, thank you so much for that. So that was welcome on board, and thank you so much for spending your time again this evening. All right, thank you. So Few takeaways from both Brett and Richie's strategies are that you can use our strategies and the strategy sessions and all that as a framework to really understand what trading is all about. Practice your own strategies, or practice whatever is taught in the strategy sessions, and then learn to apply that. I mean, it's really not just about learning. Okay, here are 5 rules. I'm going to learn